Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 123, and in this episode, we are reviewing the performance of the global markets during the 35th week of 2024, and that is from Monday the 26th to Friday the 30th of August. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where according to the Fed's preferred measure, the rate of inflation edged higher in the month of July as the central bank prepares to implement its first interest rate cut in more than 4 years. On Friday, the Commerce Department reported that the Personal Consumption Expenditures Price Index rose by 0.2% for the month and was up by 2.5% compared to the same period last year. And excluding volatile food and energy prices, the core inflation data also increased by 0.2% for the month, but was marginally higher at 2.6% over the past 12 months. The Federal Reserve considers the core reading a better gauge for the longer-term trend of inflation. And according to the CME's FedWatch tool, the markets are currently pricing in a 100% chance for a rate cut in September, but lowered the probability for a 50 basis point rate cut to about 30%. And over in the Eurozone, flash figures from Eurostat showed that the rate of inflation in the 20-member trading bloc declined from 2.6% in July to a 3-year low of 2.2% in the month of August, and in the process boosted expectations that the European Central Bank would once again cut interest rates in the month of September. Meanwhile, the core inflation rate, which excludes volatile food and energy prices, these fell to 2.8% in August, down from 2.9% in July. In tandem with the rest of the bloc, the inflation rate in Germany, which is the largest economy in the Eurozone, cooled more than expected to 2% for the month of August. Following its first rate cut in June, the markets have fully priced in that the European Central Bank will implement another 25 basis point rate cut in the month of September. In the global headlines this past week, on Wednesday, Berkshire Hathaway hit a market capitalization of $1 trillion and became the first non-technology company in the United States to achieve this coveted milestone. Shares of the Omaha, Nebraska-based conglomerate have so far rallied more than 28% in 2024 and were last recorded trading at just above $696 $8,000 per Class A share. In the U.S. stock market, traders were focused on the inflation data as stocks rose across the board on Friday, with the Dow Jones Industrial Average posting a fresh record high as the market closed a volatile month on a high note. All the three major averages suffered a major sell-off at the beginning of August, but recovered steadily during the course of the month. The S&P 500 posted a monthly gain of 2.3%, whilst the Dow climbed by nearly 1.8%, and the Nasdaq Composite advanced by 0.7% during that period. On Friday, the 30-stock Dow jumped 228 points to close at another record high of 41,563, whilst the S&P 500 advanced by about 1% to end the day at 5,648, and the tech-heavy Nasdaq Composite gained by 1.1% to eventually settle at 17,713. In the U.S. bond market, the yield on the 10-year Treasury rose on Friday as investors digested the latest batch of inflation data. Treasury yields ticked higher after the Federal Reserve's preferred indicator for inflation rose by 2.5% in the month of July and could influence the outlook for interest rates as well as the Fed's decision at the next policy meeting in September. The yield on the benchmark 10-year note was up by nearly 6 basis points at 3.92%, whilst the yield on the 2-year Treasury note gained by about 4 basis points to settle at the same level of 3.92%. According to the CME's FedWatch tool, markets have fully priced in a rate cut in the month of September, and traders are currently pricing in about a 69% chance for a 25 basis point rate cut and a 31% chance for a 50 basis point rate cut. For your information, bond yields and prices move in opposite directions, and 100 basis points is equivalent to 1 percentage point. In the commodity markets, the price of crude oil retreated on Friday as investors weighed on the expectations for an increase in supply alongside reduced hopes for a 50 basis point rate cut at the Fed's September policy meeting. The Organization of Petroleum Exporting Countries and its allies, known as OPEC+, is set to increase production from the month of October, and this is in order to offset the outage from Libya and to deal with production cuts by members who are concerned about overproduction and the impact of sluggish global demand. In response to the foregoing, the price of Brent crude declined by 1.43% to close the day at $78.80 per barrel, whilst the price of the U.S. benchmark West Texas Intermediate crude fell by 3.1% to eventually settle at $73.55 per barrel. In the precious metals market, the price of gold was on track for a monthly gain as the US dollar and Treasury yields stabilized on Friday after the latest inflation data matched expectations and with a September rate cut fully priced in. Meanwhile, physical demand for gold remained subdued in the Asian markets as new import quotas failed to lift Chinese demand. In response, the price of spot gold rallied to an all-time high of $2,531 and was on track for a monthly gain of 2% before eventually coming to a close at $2,503 per ounce. In the cryptocurrency market, a significant decline in the value of Ethereum appears to have triggered a wave of liquidations on the Bybit exchange as cryptocurrencies declined sharply across the board on Tuesday. According to CoinGlass, the futures market experienced a liquidation of long Ether positions valued at about $93 million, which forced traders to sell off their crypto assets in order to settle the escalating losses on their margin trading accounts. According to Coinmetrics, the price of Bitcoin was down by about 6% on Wednesday, but on a year-to-date basis is still up by about 39% and was last seen trading at around $59,400 per Satoshi. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country. Data released by the Kenya National Bureau of Statistics on Saturday showed that the Consumer Price Index for the 12 months to August 2024 rose to 4.4%, and this was up from 4.3% in July. The slight tick-up in inflation was a break from the declining trend and was mainly attributed to an increase in food prices, which rose by 5.3% in the 12 months to August 2024. At its last policy meeting on the 6th of August, the Central Bank's Monetary Policy Committee cited easing inflation and a stable shilling when it decided to cut its policy rate by 25 basis points to 12.75%. And just for your information, the central bank's medium-term target range for inflation is set within a range of between 2.5% and 7.5%. In the domestic foreign exchange market, during the past week, the Kenya shilling was relatively stable versus the US dollar, and according to data obtained from the Central Bank of Kenya website, the official exchange rate for the US dollar was quoted at 129.04 compared to 129.08 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a narrow range of between 131 to 132 shillings. And a quick survey of the market showed that the lowest rate was offered by Stanbic Bank at 131.25, whilst the highest rate was quoted by Equity Bank at 131.75. Meanwhile, the sterling pound was priced at 170.38 and the euro was valued at 143.44. And on the regional front, one Kenyan shilling was changing hands for 28.83 Ugandan shillings and 21.06 Tanzanian shillings, and to the Rwanda's franc, it was posted at 10.31. The shilling now appears to be relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak. This is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. And given these fundamentals, I expect that the shilling will continue to remain under pressure for the foreseeable future until such a time that we get our national debt under control. But as we all know by now, there are no solutions to excessive debt, just consequences, usually in the form of higher taxes. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined by $55 million to $7.34 billion, which is still equivalent to 3.8 months of import cover. This level of reserves falls below the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing national debt that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently well funded and was also supported through open market operations. Open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined marginally by 14 basis points to 12.80%, and this was down from 12.94% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 15.2 billion shillings, down from 16.6 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 20.3 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 29th of August, and the central bank received bids totaling 24.2 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 101%. The central bank ended up accepting 23.6 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by about 1 basis point to average out at 15.78%, whilst the 182-day rate declined by 3.5 basis points to close out at 16.63%. And the 364-day rate was marginally lower by 1.7 basis points to finally settle at 16.84%. In the primary bond market, the TBILL auction for the reopened 17-year infrastructure bond was held on Thursday, the 29th of August, and the central bank received bids totaling 35.1 billion shillings against an advertised amount of 15 billion shillings, representing a performance rate of about 234%. The central bank ended up accepting 32 billion shillings at a weighted average rate of 17.72% vis-a-vis the bond's coupon rate at 14.39%. In the international markets, during the month of August, the yields on Kenya's Eurobonds were on a downward trajectory, with the yield on the 7-year 2019 Eurobond decreasing the most by 60 basis points as it fell to 9.9%, and this was down from 10.6% that was recorded at the end of July 2024. At the Nairobi Securities Exchange, during the month of August, the equities market recorded a mixed performance, with the NSE 20 and the NSE 25 gaining by 0.5% and 0.2% respectively, whilst the NASI and the NSE 10 declined by 1.9% and 0.5% respectively. The market's performance was driven by losses recorded by large cap stocks such as Safaricom, East African Breweries, and DTB Bank, which declined in value by 8.8%, 4%, and 2.3% respectively. These losses were, however, mitigated by gains recorded by other large cap stocks such as Bamburi Cement, NCBA Bank, and Standard Chartered Bank, which increased in value by 25%, 7.6%, and 7.4% respectively. Up next is our topical issue, and this week we start by looking at tax collections for the month of July. The latest data released by the National Treasury shows that tax collections in the first month of the current fiscal year grew at the slowest pace in over a decade, with the exception of the COVID-19 pandemic period. The slow pace of growth was attributed to the recent wave of anti-government protests, which disrupted business operations and dented investor confidence in the Kenyan economy. Tax collections in the month of July grew by about 2.9% to 159.5 billion shillings, and this is compared with a growth of 18.7% for the same period last year. This in turn has prompted the Treasury to tap into its overdraft facility at the central bank in order to avoid defaulting on its domestic debt repayments. Our second topical issue is based on an article that appeared in the Business Daily this past week, which suggests that there could be some shenanigans going on in the domestic bond market. According to the article by Jaindi Kisero, there have been some very strange dealings in the bond markets. And this came to light through a letter from the Central Bank of Kenya to the Capital Markets Authority requesting the market regulator to investigate recent bond trades between some brokers and the National Social Security Fund. In the letter to the Capital Markets Authority, the central bank said it had conducted an analysis of the trades in question, which revealed that the National Social Security Fund was buying bonds at a significantly higher price than the market average. In addition to that, the central bank also noted instances where the fund had sold bonds at lower prices and a few days later had bought back the same bonds at much higher prices. According to the central bank, these potentially illegal trades were carried out between May and July this year. And the purpose of the central bank letter was to request the Capital Markets Authority to review the conduct of the parties involved and to take the appropriate actions with advice to the central bank. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, your experience of life is simply a reflection of what you believe to be true. Think about it. Thank you, and God bless.